Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm thrilled to welcome Danielle DiMartino Booth to the show. An economist, former Fed advisor, Wall Street veteran, and the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. Danielle believes that current valuations in the broad market are not tethered to reality, and she draws parallels to both the tech wreck and global financial crisis in making a case that although the market can remain irrational longer than we can remain solvent, eventually reality has to come home to roost, and the result won't be pretty. Danielle also provides her thoughts on the gold market and the question of gold revaluation, a growing crisis she sees in the U.S. housing market, how the debt and deficit situation could potentially be solved, and so much more. So strap yourselves in for my conversation with Danielle DiMartino Booth. Danielle DiMartino Booth, it is great to have you on Commodity Culture. I want to kick things off with your assessment of the Trump administration's economic and trade policies thus far. It's now been around 9 months since Trump took office. What do you make of the policies and strategies coming out of the administration and the efforts of Treasury Secretary Scott Bessent, good, bad, and ugly?
So, I think that a lot of the policies could have been more carefully deployed at this juncture. I don't think anybody would agree with me. The uncertainty factor is pretty high at this point for a lot of American companies. We see that as evident in hiring freezes and declining capital expenditure plans. We will see if the big beautiful bill, if the passage of that bill unleashes a wave of investing. There's certainly a lot of hope as it pertains to that. And specific to Treasury Secretary Scott Bessent, I would say that he has definitely been a calming force, a calming influence throughout his short tenure. So again, I don't think I'm alone in giving him pretty high marks since he started off heading up the nation's Treasury Department and wearing quite a few hats, I would add, as well, because there has been something of a revolving door with a lot of, sorry, I didn't mean to be making my laptop bounce around, but there has been something of a revolving door with other officials that have been calling on Bessent's time to wear many different hats.
Well, I want to also discuss the broad market with you because I have a lineup down the block of guests on this show for the past 3 years who have been pounding the table that the market is extraordinarily overvalued by a number of different metrics and that we are set for a massive correction. Some are calling for a long-term bear market ahead for the Mag 7, the three big indices, and just the overall broad stock market. What is your view here? Do you think there is an argument to be made for the market to continue to move higher? Where do you stand on the issue of the current health of the broad market?
So I think this is a market that is driven by passive flows and by momentum and by speculation, and a lot of similar elements were around in 1999 and in 2000, and we saw, of course, that bubble inflate and valuations get higher than anything that we thought that we would see. So hopefully we've learned a little bit from that you can certainly go broke if you're using valuations purely as a timing mechanism. We know that does not work. And again, I think that the changed structure of the stock market is what's really relevant here. As long as you have more individuals who are contributing to target date 401k funds, then you're going to have continued increases in market cap weighted passive investing index type strategies. It's just a fact of life. We do, however, have shifting demographics, and that is, I think, a key differentiator between now and what we did see in 2001, 2007, and that is that we've got upwards of 11,500 Americans retiring every day. Of course, they're no longer contributing to 401ks. And then we've had some serious weakness in the market for college graduates as well. So it's a matter of simple math. You have to have more people coming into the job market to offset retirees, or you're going to start to turn the direction of those passive flows. And so when that happens, then you do begin to run the risk of seeing a major correction in the markets. And I would add to that a lot of the revenue expectations going out several years into the future is very reminiscent of what we saw in 2000, in the year 2000, in 1999. And I think there is a growing recognition that there's going to be some cannibalization in the AI space, and that not all of the companies that are making extraordinary investments today are going to end up being the winner, the one or two big winners in the AI space, meaning that there is some large degree right now of sunk costs being incurred. And and we're also seeing it play out in companies begin to take debt on to support their investments in artificial intelligence. So, could we see momentum continue for the next 6 months? Could there be hopes that Fed rate cuts are going to unleash a wave of liquidity? I certainly think that the momentum trade can continue, but what we have to remember is that we're not talking about zero interest rate policy and the relaunching of quantitative easing just yet. Right now, we're talking about whether it's going to be a quarter of a point or a half of a percentage point rate cut at the September meeting, and maybe a follow-up to that at the October meeting. But we're certainly not talking about anything remotely resembling just yet the zero bound.
And now a quick break to hear from our sponsor, ARK Silver Gold Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1 ounce coins, mint fresh, only $2.47 over spot. Mint fresh silver maple leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arksgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Excellent summary. You mentioned the job market here. We've seen massive job market revisions to the downside recently, surprising some. I think that a lot of the statistics that are coming out of the government for some time now have been cooked in one form or another. Firstly, what are the implications of this downward revision? And secondly, with all the massaging and downright false information that goes into a lot of government statistics, job market reports, inflation statistics have changed massively since the 80s. Is there any real reason to even be paying attention to that data at this point?
Well, the reason you have to pay attention to the data is because the biggest investors are paying attention to the data. So it's not exactly a deeply satisfying or intellectual response. But for better or for worse, when non-farm payrolls hit the headlines on non-farm payroll Friday, investors pay attention. They move money around based on that. Algorithms key off of what the data is. So if anything really has changed, I would say in the medium term, it's that it looks like the revisions are more real time in nature. And that means that we're seeing true downward momentum in the payrolls data. We've got the unemployment rate at 4.3%, which is still historically very low, but nonetheless the highest of the current cycle. And again, if these revisions are starting to come through in real time, June of 2025, we had net job destruction. We had payroll losses for the month. We found out about that just 2 months after the June data were revised. That's a heck of a lot faster than having to wait 18 months to find out what happened in March of 2024, for example. April of 2024. We didn't find out what the state of the job market was then until this past September, the current month that we're in. But so I think investors should definitely be attentive to increased downward momentum in the payroll data, because that is when things can start. That's when the ground underneath you can start to shift more quickly.
And speaking of inflation statistics, the official headline CPI around 2.9% has been rising recently. And of course, most are expecting the Fed to cut rates at the FOMC meeting tomorrow. You mentioned they're trying to figure out whether it's going to be 25 or 50 basis points. That seems to be the debate, not if they're going to cut. What is the logic of cutting rates here in the face of rising inflation? And perhaps the deeper question is, does adjusting the Fed funds rate either up or down really accomplish anything significant in today's economy?
So, the answer is we have seen tangible evidence that refinancing applications have gone up. A lot of Americans are watching their FICO scores fall. They're facing rising consumer delinquencies, whether you're talking about automobiles or credit cards. And so, to the extent that people really need to access cash, and are trying to tap into their home equity, we're seeing tangible evidence that even a 25 basis point decline in your mortgage rate can get some action going. But in the broadest sense, no, we're seeing a lot of mortgage purchase applications to purchase homes. We're seeing a lot of banks refusing to the applicants. And do I really think that 25 basis points, that a quarter of a percentage point is going to move the needle when it comes to commercial real estate or small business lending? No. Again, I think a lot of the hope that's out there is that when people start to talk about the Fed lowering interest rates, they're not talking about going, just a quarter of a percentage point. They're thinking in the back of their mind, because that's how investors have been trained to go, oh, the Fed's going to zero overnight, and then they're going to relaunch the purchases and growing their balance sheet. We're not in the middle of a global pandemic right now, and there is no financial crisis that we see. We have bankruptcies that are piling up. We still have the lagged effect of the Fed holding interest rates at a higher level than they certainly have in modern history. So that is still playing out. But as far as the zero bound in QE, we're not there yet.
Do you think part of this is motivated by political pressure in terms of Powell getting pressured by Trump continuously to lower rates? And do you think the bigger picture for the US government in terms of wanting a rate cut is to lower the interest expense on their own debt?
Oh, well, I mean, that is the obvious motivation here. But I think Powell has proven himself in spades that he is not going to bow to political pressure, but rather I think that there has to be a recognition, even for Jay Powell, who contended until the last meeting in July that the labor market was still solid, that the labor market is no longer solid. The Fed is a dual mandate institution. Even though inflation is not at the 2% target, and the fact that it is closer to 3%, the Fed does have to acknowledge the weakening in the job market in some way, shape, or form, even if it's just a signaling, if that 25 basis points is not going to do a lot, holistically speaking, for the broader economy.
And with everything we've discussed so far as the backdrop, what are your thoughts on gold as an asset right now? What do you think are the main factors that have been driving the gold market to this point, recently reaching all-time highs after being in a consolidation pattern for around 4 months? And what role, if any, do you see gold potentially playing in the monetary system and the global economy ahead?
So I think that first and foremost, there have been fundamental drivers of the recent increase in gold prices. Central banks have been buying quite a bit of gold, but more fundamentally, gold is considered to be a hedge. And when you are completely uncertain about what tomorrow holds, then you naturally flock into the arms of precious metals. It's simply the way of the world, and it's been how it's worked. As far as gold's role in the future monetary system, there's not a practical way to make that happen without crashing the world's largest economy. So even though I am a vocal advocate for sound monetary policy and for sound money, I don't think that there is a pathway right now to readopt a gold standard, if such a thing is being contemplated. But I do think that concerns about rate cuts potentially igniting inflation, and uncertainty about the record valuations that we've discussed right now in risky assets is sending investors fleeing to hedge their portfolios with gold, and that makes perfect intuitive sense.
And do you have any thoughts on the prospect of the U.S. revaluing its gold reserves? This is something that's been floating around recently, particularly since the Fed released a report which focused on some other countries that had revalued all or a portion of their gold reserves and the implications of that. That led to speculation online that they are considering a similar move, as at the moment, gold is held at $42.22, I believe, somewhere around there on the Fed's balance sheet. Do you think this is a realistic proposition, and would it actually accomplish anything?
Well, so, I'll give you my disclaimer. I'm 9 hours shy of sitting for my CPA. So that's how I left business school, was 3 classes shy of being a bona fide certified public accountant. I think $750 billion could certainly be helpful. But in an economy that's $28 trillion in size with these massive deficits, the accountant in me says that it would be a one-time accounting maneuver in order to revalue what's on the balance sheet of the United States. And it would last for about as long as $750 billion lasts in the United States, which I think is 3/4.
Right. Another area you've been sounding the alarm about recently is the housing market in the US. What has you most concerned there? And what could the implications be of a meltdown in the housing market for the broader economy?
So that's a much different question. And I think the fact that, as I mentioned earlier, mortgage applications are being rejected by banks. Banks are definitely clamping down on their lending standards. We just had a big subprime automobile lender, Tricolor, blow up and leave, leave banks with some losses. To the extent that lending standards are tightening, I think that makes life a lot harder for the Airbnb jocks of the world, who really do require loose lending standards, the ability to tap into constant financing to support their portfolios of short-term rentals that they were anticipating when they got into the game, always having rising weekly rental rates. It certainly isn't the case right now. And again, I would bring up the subject of demographics on top of this, because not only do Americans the age of 70 and older own 40% of the US stock market, so they cannot see interest rates go to the zero bound. By the way, they cannot go back into the workforce right now. They're just too old. The median age of a baby boomer is 71 years old. But not only are baby boomers more apt to sell their stock than they have been in prior cycles, they own 25% of residential real estate. So that's a quarter of homes in America that are owned by baby boomers. If you were to see a correction, if baby boomers were to be concerned because they keep reading about record high valuations in the stock market, then you start to see things like Redfin reporting that in data going back 12 years, second home sales have fallen to the lowest on record. That is the absence of activity in an area that is of great interest to retirees in the United States, who own 25% of residential real estate. And by the way, if you take the demographic argument one step further, the falling birth rate in the United States, out-migration at the same time, means that there are fewer buyers. And there are certainly fewer buyers for McMansions and some of the larger homes that the baby boomer generation has amassed over the years. If you've only had 1.25 children, you don't necessarily need 5 bedrooms. And that, I think, is going to be something of a demographic divide. And you're going to see a clashing of demographics there, because there simply aren't enough young American families with 4 or 5 children to put into a house and fill up those great big homes, much less the ability to afford to get into such a high mortgage. So I think you're going to have some structural pressures on home prices going forward that are not going to go away for a long time.
You recently wrote a piece on Quill Intelligence titled "Deception in Plain View, the Private Credit Ruse Comes to Light." Can you walk us through your findings in that report?
So I go back to Tricolor, the subprime auto lender that blew up. It had warehouse lines of credit with several banks at the same time based on the same collateral. That was a blow up in the private credit space that became very public. And the concern is that because there's not the same amount of due diligence, because borrowers in the private credit space we're finding out the hard way tend to be even lower credits than junk rated borrowers or leveraged loan borrowers. Because of that, and because of the massive increase in the growth rate of the private credit market, I think that this is an area where you could see illiquidity become very problematic. And you could, I don't necessarily think Tricolor is an isolated situation. I think it's much more, to allude to the color that I'm wearing today, I think it's much more of a canary in the coal mine.
Interesting. When looking at the market today, from your perspective, What are the areas of the market and the asset categories that you think are presenting a potential opportunity, and what areas of the market are best avoided in your view?
So I think investors should look to some of the more boring areas of the market, because you have to look at investing kind of through the prism of somebody who, I'll go back to my median age of baby boomer is 71. So if the Fed starts to aggressively lower interest rates going forward because the job market continues to weaken, what are these people going to buy in the stock market or in the bond market if cash stops paying them enough to live on in their fixed income existence? And so, companies that will not be threatened with cutting their dividends, that are going to produce cash flow. Those are some of the areas that baby boomers will flock to if they don't make the decision to sell their stocks outright. They would not be going to companies that do not throw off cash flow streams. So I think that is an area where investors should be mindfully hedged going forward. So again, it seems like every question you ask me goes back to the idea of demographics, but demographics is our destiny. It was not in 2001. And demographics was not our destiny in 2007. There were options at the time for this massive baby boomer generation to stay in the workforce or to rejoin the workforce. But that is no longer the case. So you have to be one step ahead of where they're going to be in their thinking and be positioned to benefit from areas within asset classes where they're going to be putting their money if need be.
And then areas of the market that you would be avoiding at this point in time.
Well, I mean, again, it's every bubble inflates for longer than anybody ever anticipates it inflating. But you certainly would not want to have full on. Right now, the average American portfolio is 72% stocks. To the extent that you're in that large cohort, you just have to be mindful of what your age is and how long you can weather any potential disruption in the market. But the sell-off would seem to always start historically in the most overvalued areas. And there's no reason to think that this time is any different given some of the aggressive, shall we say, revenue projections that are being made by some of these big players right now.
And any thoughts on the fixed income market, maybe starting with U.S. Treasuries, and your thoughts on commercial paper and maybe even emerging market debt? Is that an area that you could see being attractive?
So, right now there are a lot of individuals, there are a lot of my cohorts out there that are getting long duration. They're terming out their debt exposure. If you're in recession, or I should say it differently because we started losing jobs in the second quarter of 2024, if markets begin to recognize recession, then you do tend to have falling yields further out on the yield curve. As far as commercial paper goes, boy, we've seen a renaissance there. I mean, commercial paper, the whole market has come roaring back, and that, of course, is a cash alternative way, very short term, for corporations to buttress their true cash positions. So, in that sense, you would be barbelling your exposure, if you will. I'm not an expert in emerging markets debt, so I'm probably not the right one to ask about that, but I would caution that at a higher level, we're seeing pullbacks in many manufacturing economies because there was a ton of front load buying in front of the threat of tariffs, and now that inventory stock building wave is coming to an end, now you're starting to see kind of a retrenchment of manufacturing weakness in other countries, and that will always have a bleed-on effect to smaller economies that rely more on the manufacturing industrial side of their economy than they do the services sector.
I'd love to get your thoughts on the U.S. government taking a 10% stake in Intel, with them also indicating that they may be open to taking a stake in other AI and chip companies moving forward as well. Is this a strategic move that makes sense in your view?
So this might be the shortest answer that I give you today. I'm a big proponent of the idea that the best way to destroy something is to invite the government in. Um, it probably would have been a more realistic route to take to, as they were discussing prior to the government's announcement, to break up Intel and to try and harvest value in that manner to the greatest extent for the shareholders and stakeholders. I'm just a free market libertarian at heart, and I don't think the government becoming involved is ever going to improve things.
Yeah, I agree
And
with
I'm a
that
capitalist,
sentiment.
so I mean, so yeah, it kind of goes against my grain.
Yeah. I'd like to get your thoughts as well on how does the debt and deficit situation get solved in the United States? Because we have this massive chunk of entitlement spending, which is essentially untouchable from a political standpoint, because if you want to get elected or reelected, you cannot take things away from a mass of the population. So how do we solve this problem? Obviously, there's no easy answer, but I'd love to get your thoughts considering your wealth of experience and being a former Fed insider as well.
Well, we do have Gen Z and millennials who add up to 48.5% of US voters. So we could actually see change on the entitlement front. But you're right, they're sacred cows. They don't want to be touched. No politician wants to be the one coming in and cutting Medicare, cutting Medicaid, cutting Social Security benefits. And it's a real problem for the United States when we're speaking about the long term. And, at some point, some politician will have to address, I sound like I'm speaking to you and you're speaking to me in French. It sounds like we're talking about the French economy here. But at some point, we're going to have to make some mature decisions about retirement ages and increasing retirement ages in this country so that we can start to get entitlement spending going forward under control. Or you're going to talk about funding running out before the baby boomers burning through all of these trust funds before really even beginning to die off in earnest. I mean, we know that healthcare in the very last few years of life is extraordinarily expensive, and we're talking about the government footing that bill.
And you are the author of Fed Up, an Insider's Take on Why the Federal Reserve is Bad for America. So I have to ask you, we're going to finish on the question of ending the Fed, something that Ron Paul has been championing for some time now. And a lot of people believe this could solve a lot of problems relating to the U.S. economy. Are you in that camp? Do you think ending the Fed would be beneficial? Could it have negative effects? And is there even a realistic route to undertaking such a task?
So I think the Fed's independence is definitely at risk, but that's more an internal between the Federal Reserve and the U.S. Treasury. I've met Ron Paul, and I certainly respect a lot of his views, given what the Chinese did to intellectual property when it was unguarded and it was able to be hijacked. I was looking for a polite word, but screw it. But given what happened with our intellectual property, I dare say that if we were to leave the financial system completely unprotected, that we would certainly be opening ourselves, increasing our vulnerability to a great extent to our financial system being taken over. And we've already seen all manner of cyber attacks, and they do indeed from time to time infect large financial institutions. So the idea of leaving the biggest financial system in the country unguarded and is just not prudent in my view. Now, the entire last chapter of Fed Up is devoted to how I would take the Federal Reserve down to the studs and rebuild it from the ground up. In fact, Treasury Secretary Bessent has echoed me in a lot of the solutions that he feels are appropriate going forward for the Fed to be accountable in its decision making, for the Fed to maybe not have to have 786 full-time PhDs on staff, for there not to be the same 12 districts that existed in 1913 because the U.S. economy has changed since then. Anyways, the final chapter of Fed Up goes through radical changes that need to be undertaken at the Fed that almost end it. But ending it is not a realistic route to take, in my view. But I certainly sympathize with people who feel that the Fed should be ended, because what they're really crying out for is for markets to price. And there's nothing wrong with that. Price discovery should be a goal, and the Fed the Federal Reserve should not have a place in making market prices.
Well, Danielle, this has been a fantastic discussion. Tell us about Quill Intelligence and where people can get a copy of your book, Fed Up.
So most major libraries have got a copy. I recorded the book myself as well. I think we probably had more activity on Audible, and I'm coming up on my 10-year anniversary in just 18 months of releasing Fed Up, but we still have quite a few people listening to the Audible book and buying it. Unfortunately, on Amazon. There are other places I'm sure you can get it. Been a long time since somebody's asked me about how to get Fed Up. But again, in most major libraries, if you just want to check it out and give it a read. I just had my 10-year anniversary of founding QI Research after I left the Federal Reserve System myself. We publish the Daily Feather for more retail investors every trading day of the week, DiMartinoBooth.substack.com. And for institutional investors, we publish 8 times a week. We have a very raucous, fun, great Bloomberg chat room. We publish 8 institutional products a week for those clients as well. So come to QIResearch.com and learn more if you're in the business of running money for a living.
Great. Well, I will put links to all of that in the description below. Thank you so much, Danielle. It's been a blast.
Thank you for having me.
And thank you for joining us today. Take advantage of ARC Silver Gold Osmium specials right now. Silver Kangaroos, 2023 1-ounce coins, only $2.47 over spot. Silver Maple Leafs, 2025 1-ounce coins, just $2.87 over spot. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And be sure to pick up your merch, hats, t-shirts, hoodies, mugs, all backed by a 100% quality guarantee. Use the link in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.